Welcome to Edgemoor Investment Advisors' video presentation of our third quarter 2025 market review and outlook. I am Gay Truscott, and I'm joined today by my colleague Steve LaRosa. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, www.edgemorinv.com. Here are the topics we will cover today. Q3 2025, another record quarter for stocks. The Fed makes its move. The U.S. economy sending mixed messages. The government shutdown, portfolio implications and actions, Edgemoor's outlook, and a review of two selected securities. Let's get started. Stocks registered another record quarter in the 3 months ended September 30th, posting their strongest third quarter performance since 2020. The S&P 500 index hit 23 record highs during the period, among the most ever in a single quarter. As seen on this slide, the S&P 500 index, which is the broadest measure of the stock market, posted a total return of 8.1% in the third quarter and is up 14.8% year to date. Momentum built throughout the quarter as market volatility remained unusually low, and investor sentiment was lifted by strong corporate earnings, continued optimism around artificial intelligence or AI, and expectations for a new cycle of monetary easing, i.e. rate cuts. All of these positives played out despite ongoing concerns about tariff and trade policies, slowing labor conditions, and geopolitical crises around the world. Technology and communication stocks once again drove the rally, with the tech-heavy NASDAQ returning 11.2% in the third quarter and 17.3% year-to-date. Still, a strong showing by industrial, financial, and material stocks fueled a more broad-based market rally in the third quarter than we've seen for quite some time. And for the first 9 months of 2025, all 11 sectors of the S&P 500 generated positive returns. Bonds also posted gains, with the Bloomberg Aggregate Bond Index returning 2% in the third quarter and 6.1% year-to-date. The Fed makes its move. The Federal Reserve announced its first interest rate cut of the year at its September 17th meeting, cutting its benchmark short-term Fed funds rate by 0.25%, or 25 basis points, to a target range of 4 to 4.25%. This marked the first rate cut since December of 2024 and was largely prompted by a softer-than-expected August jobs report. The move was applauded by investors as it was seen as a measured step to support economic growth by balancing concerns about inflation with the need to support the labor market. Looking ahead, the Fed also signaled 2 additional rate cuts before the end of the year, which, if they occur, would provide a further tailwind for equities. Now let's turn to the U.S. economy, which has been sending some mixed messages lately, with strong GDP growth, on the one hand, counterbalanced by a slower labor market on the other. Let's begin with the positives. Strong GDP growth. U.S. GDP grew at a better-than-expected annual rate of 3.8% in the second quarter of 2025, and is projected to grow by 3.9% in the third quarter, according to the Fed. These strong growth numbers were driven by increases in both consumer spending and private business investment, offset in part by reduced government outlays. Next, resilient corporate earnings. Corporate earnings have been another bright spot in the economy, continuing to grow at a solid rate so far this year. Year-over-year earnings of the S&P 500 grew by 11% in the second quarter and are expected to grow by nearly 8% in the third, which would be the 9th consecutive quarter of earnings growth for the index. But not all the economic news is this optimistic. Let's talk about headwinds. The U.S. labor market is gaining focus as it has now started to show signs of slowing. The August unemployment rate rose to 4.3%, up from 4.2% in July, as a modest 22,000 jobs were added during the month. The unemployment rate has shown a steady uptick since June, when it stood at 4.1%. Persistently weak hiring since the spring has contributed to this uptick, but the lack of mass firings has also kept a lid on unemployment. Meanwhile, consumer confidence fell in September to the lowest level since April, due to growing worries about this labor market. Private sector businesses cut jobs for the third time in 4 months in September, marking the weakest stretch for the job market since the pandemic. And finally, fears about inflation reigniting continued to play out in August. The Consumer Price Index, the broadest measure of inflation, increased by 2.9% year over year in August, up from 2.7% in July. Elevated costs for food, shelter, and services contributed to the increase, while moderating costs for energy and medical care provided some marginal offset. So again, lots of mixed signals about the economy. Now let's address the government shutdown. Congress failed to pass a continuing resolution to fund the government beyond midnight on September 30th, causing the government to shut down. Now, there have been several shutdowns since the Congressional Budget Act was passed in 1974, with some lasting just a few hours, and others, like the last one in January of 2019, lasting several weeks, 35 days to be exact. Prolonged shutdowns can impair economic activity and reduce government revenues and spending. But historically, financial markets have treated shutdowns as a short-term disruption, triggering a short-term risk-off reaction. That means volatility can rise, the dollar may fall, and stock markets can sell off. But the depth of a sell-off tends to mirror the length of the shutdown, with markets bouncing back quickly once government operations are restored. It is no secret that we live in a heightened political climate, so there is greater uncertainty around the current shutdown. But while we will be watching the situation closely, we do not anticipate any changes to our long-term investment strategy. Now I will turn it over to Steve to talk about portfolio implications and actions, our outlook, and to review 2 of our selected securities.
Thank you, Gay. Given the economic, fiscal, and geopolitical uncertainties in the current environment, we remain somewhat cautious on equities in the near term. We also consider the broad stock market to be fairly valued, based on the S&P 500's current forward price-to-earnings ratio of approximately 22.5 times, just above its 5-year average of 20 times. However, we also believe that many parts of the stock market warrant valuations higher than historical averages, based on factors such as technological progress, productivity advances, and increasingly asset-light business models that have produced consistently higher profit margins and free cash flow for many companies in the S&P 500 index. In addition, not all segments of the market carry lofty valuations. For example, many healthcare, energy, and financial stocks are trading at valuations that are substantially below the market's average PE multiple, and we continue to look for opportunities in these and other undervalued sectors. Overall, we continue to favor more value-oriented, dividend-paying stocks that have strong cash flow characteristics, leading market share, and a wide economic moat and solid growth prospects. And while we still own short-term treasury bills with annualized yields just below 4% for excess cash, we are on the lookout for additional income securities as those treasury yields continue to decline. As of right now, our outlook for the markets is guardedly optimistic, as we believe volatility may continue in the short term until there is more clarity on the path of unemployment, interest rates, and the longer-term impact of tariffs on the economy. Despite these near-term uncertainties, we emphasize to our clients the importance of sticking to a long-term investment plan focused on their specific goals and objectives. We believe that our patient, disciplined approach to individual security selection offers our clients strong, long-term return potential in a cost-effective and tax-efficient manner. We truly appreciate our clients' confidence in our time-tested investment philosophy, and we remain steadfast in our commitment to helping our clients and their families reach their long-term financial goals. We are also proud to share that Edgemoor Investment Advisors has been ranked number 17 on CNBC's 7th annual Financial Advisor 100 list for 2025, which ranks and recognizes the top investment advisors in the country. Edgemoor has now ranked in the top 40 on this list 5 separate times in 2020, 2021, 2022, 2024, and 2025. We believe this accomplishment is a true testament to our firm's consistency, longevity, and track record. Those attributes have been key to our success in the past, and we are committed to maintaining them in the future. Now, I'm going to discuss 2 securities that we are currently buying for client accounts, Booking Holdings and U.S. Bancorp. I will start with Booking Holdings, Inc., which is the world's largest online travel agency by sales, offering travel reservations and search services for hotels, alternative accommodations, flights, cars, restaurants, vacation packages, and cruises through its website and mobile app. Booking's size and scale have allowed the company to spend more on marketing, advertising, and technology than most of its competitors, resulting in steadily increasing market share and a loyal customer base. Global travel demand has remained strong post-pandemic as consumers continue to make travel spend a core part of their budget. Booking's share of the approximately $3 trillion global travel market is still just in the single digits, offering plenty of room for future growth. Booking's business model is asset-light, relying more on technology and partnerships to drive business as opposed to physical assets or brick-and-mortar buildings. This model has allowed Booking to generate what we view as high profit margins, strong free cash flow, and attractive returns on assets and invested capital. Booking has a long track record of industry-leading growth, operational performance, and strategic execution, which has resulted in strong outperformance over time. We believe Booking remains an attractive investment, as it is a high-quality company with solid long-term growth potential that is trading at a reasonable valuation. Next, I'm going to review U.S. Bancorp, which is a recent addition to Edgemoor's income portfolios. U.S. Bancorp is among the largest regional banks in the United States, with $685 billion in total assets and a presence in 26 states across the Midwest and Western regions. U.S. Bancorp is also among the most profitable regional banks due to its unique mix of traditional loan and depository services, with highly profitable fee-based services such as payment processing, corporate trust services, and wealth management. The bank has consistently earned returns on equity well above its peers, which is a source of its competitive advantage and wide economic moat. Edgemoor added USB shares to our income portfolios because of what we believe is an attractive and growing dividend, currently yielding 4.3%. U.S. Bancorp has increased its dividend every year since 2010, and we believe management's focus on driving continued growth and efficiencies should allow the company to keep raising its payout going forward. We also believe shares of U.S. Bancorp are attractively valued, currently trading at 10.3 times forward earnings estimates. As a result of the attractive valuation and solid and growing dividend, we believe these shares are a good addition to our clients' income portfolios. That concludes our third quarter 2025 video presentation. We hope you have found it interesting and informative. Please don't hesitate to reach out to us with any questions or comments, and we look forward to having you tune in again next quarter.